Okay, William, let's go to our custom spread tool. We got to build a position on the fly, I think. GRWG. We've got a Bull Call Debit spread, it looks like. And so, 121, 2022. Okay. So, January 2022. You purchased in November for a 325 debit. Currents, is it 56.97? Is it 670? Okay, so I don't have the strikes here, so I'll just mimic one. You said that the credit to close is 670. Probably the 40 and the 50, I'm guessing. Maybe? Oh, 25-35 was close. Not really, but at least I was 10 points apart. Okay, so 25 and 35. Good. Let's clear out my 40. You said a debit of 325. So let's put in buy one at 10. Sell one at 675. I know I could have done that easier, but we're just going to do it in this math for now. That'll get us to a debit of 325. There's your Bull Call Debit. Stock's really great, 56.97. And you could close out right now for 670 credit on the position with the current prices. Okay. So this is what I was going to cover potentially anyway, but in reverse, but this is a good one as well. So this, William, what we're looking at here is almost directly related to the topic at hand that we had at the beginning of the conversation for David regarding the calendar spread. This, of course, is not a calendar spread. It's going to be hard to roll out any further. I think we saw another expiration that's further if you needed to roll for a credit on the short option. But again, and you could look at it this way as David looked at it on his calendar spread, is that when I showed him rolling up the long leg and rolling the short leg, not in that order, but we rolled the short first, then we rolled the long, he says this is very similar to closing out the position and just moving it up. You can absolutely look at it that way as well. Okay. Now, you want to know about back in time or further out in time, and of course, narrowing the spread, and what cases would one use any of these scenarios? Well, you know exactly what's going to happen if I roll this whole spread up, don't you? We saw it already. It's likely going to give me a similar cost basis with a potential for an increased return, even keeping the same strike, similar to a calendar. We might actually lose some of that here, William, because it's not a calendar effect. We didn't have a 100% gain on the long, where we only had a small loss on the short. Different counter. Okay, so what do we know laterally moving up? Well, we're going to get money back, so let's just close this position. You've got one more expiration to do from where you are now. Let's just simulate the opposite transactions of closing these at this time. We've got to sell our 25, buy our 35. So that gives us, there in that case. Actually, what I'm showing now is that you said 670 credit. I'm looking at 345 if I liquidated this right now, but that's okay. So we're starting ahead 345, and that's our profit. It's showing me a straight line profit and loss chart. I keep the same expirations, but let's say we roll up now. Keep the same 5-point difference. In this case, we're starting with a win. I'm going to call it a win of 345. Okay, that's our credit to us. Now let's just add, let's pile on in the same expiration. What would you expect to see if we say rolled up? I'm going to do 50-40. I'm not going to go full on to the 55. It's too close to at the money. We're going to go up higher the win. We're going to go 50-40. Looks like it's going to be about a $4 debit, $4.50, $5 debit just for this position. Okay. So let's analyze that. And I did that wrong. You're not in a bear call now. You're in a bull call. There we go. So you had a profit of 345, and this is going to run you roughly 45. So the debit here is, again, $3 on the 10 points, making a max of $958, compared to the max position that we saw there, which was almost the same, wasn't it? Wasn't that original position almost the same? I forget. Let's go back to that. Sorry, real quick here. Yeah, the original position is now 675 credit. Okay. Okay. That's what yeah, the max profit was 675. Okay, so moving that, what we just did, would increase the return to 958 with a low exposure. So yes, if you close now, you're near the maximum. I'm not showing that you're at the maximum profit though. You said 670 was the max profit. I'm only seeing a profit of 345 because there's so much time value, William, left in those options. That's what I was seeing right now in that original view. When we close this here, 35.45, selling the 25, buying this at 28.75. So you had the debit of 320 and you're taking 670 out. Yeah, and it's not anywhere near the max profit. Okay, so we're there. But rolling this up and keeping the same strike differences, here's what you'd expect. You'd only have a debit of around $45 because the 345 profit, William, you just took off the table. The new debit would run you, as we saw, roughly in this case, it was about $2.90, close to $3. It was just about $3 there. $3.90, I'm sorry, it's about $3.90 in that case. So closer to that $4. They're a little bit higher than your original debit, not by much. But you take the 300 profit off, that lowers the cost basis down to about 45, and you get 958 from the 675 expected max profit where you are right now, and you're at a value of about 50% of that, 345, to liquidate this position and move it up to those strikes. I'm sorry, wrong link. What happens now? If I shorten the strikes, we did a 10. What happens if I pay less and go up to the 45? Remember these numbers here. 958 for rolling up this to the higher strikes, and only a small debit of 42.50. Let's take out the 40. Let's put in the 45. So now the debit's going to be less. And one advantage you might actually have here, I doubt it's going to do it, but it'd be so nice if it did. It did. Fantastic. Now, what did you do? You paid less. I was hoping to see one of these. You're in a Bull Call Debit spread that was done at a credit for $1.50. You have a bulletproof Bull Call Debit spread, William, out to January 2022, meaning if the stock falls below 45, the worst you can do is make $150, half of the liquidation value that a little less than half the liquidation of 345 we have right now. And we do take away the return. Why is the return lowered? It's because we have the smaller strikes. We're not getting 10 points back. We're getting 5 points back. But you did create a no-risk bulletproof position. A bulletproof Bull Call Debit spread that was received at a credit in this situation. And again, ignore this. That's just because the too many strikes are there. I didn't clean it up and just do this straight with the credit of 150. So, the answer to your first question, staying in the same expiration. I'm not saying that these are the strikes naturally you should choose. You have a dynamic of what range in the money that you want to be there, William, and what delta you might be looking for the short or for the long as well. But if you keep the same expiration, that's what you'd expect. Moving it up in price, you're going to take profit off the first one, so you're going to be able to increase returns. We saw that move from the 670 max up to 958. And you're likely going to limit, I think the batteries on my mouse are dying here, you're going to limit the exposure because you're going to lower the net debit of the new position by taking the profits off your existing Bull Call Debit spread. We saw that original price lowered. Now, keeping the same expiration that we're looking at and keeping the same strikes, that's what we saw first. Keeping the same expiration and lowering the strikes, making them closer, gets you potentially a credit, debit spread at a credit or bulletproof position, a no-risk trade of 150. But it doesn't really increase the maximum profit because you're giving up that extra 5 points of the 10-point debit spread you're in right now. And if you increase it to 15-point difference, where we're selling the 50 now, so we saw the 50 and the 40, we saw now the 50 and the 45, If I go to the 50 and the 35, we increase the differences to 15. What's that going to do? Well, it's probably going to give you a big bump up in maximum expected return, but it's also going to give you a big bump up in the cost. Not too bad. So now you're up to 285. Remember, our cost was only about 45 using that combination of the 10-point spread, the 40 and the 50 after closing your initial position. But the profit now is almost doubled from where you are max return that you're in right now to max return if this is adjusted. And of course, the percentage goes up because of the debit to the profit ratio. We're only 285 in now. Still lowered your cost basis some, kept it about even a little bit, but increased the return fair amount, almost double from the 650 or 670 we saw max return. We're up to about 1,200 now in that case. Those are always the trade-offs when we're looking at it, assuming the same expiration, right? So in this case, what did we see? We could lowering the strikes, making it a tighter spread, going from a 5-point to a 2.5 point, going from the 10-point to the 5-point. The lowering strikes here is going to give you a lower cost basis, but also an equal to or potentially even lower max return on those positions, because we're not getting the 10 points back, we're only getting the 5 in that scenario. Keeping the same distance and the same expiration, and we saw what that did as well. In this case, we lowered costs. We almost had a bulletproof position, didn't we? That was the bulletproof one. I'm sorry. The Bull Call Debit, earned at a credit. So that was the bulletproof one with the lower cost, and you're guaranteed 150, but the total return didn't go as high as you wanted to either. And in this scenario, the percentage return stayed about the same or lowered. Keeping the same strike difference and rolling further out, what did we saw that what did there? Well, that, of course, gave us we still lowered the cost because we took the profit in. We still lowered the cost, and we increased the return, which is probably some of the best things to do. We just don't have as high a probability going further out in time. Increasing the strikes, as we saw, what did that do? That increased the cost, but also gave us a good benefit of increasing the net credit. It's a maximum return on those positions as well. Okay. And of course, you're looking at other examples here, William, you'd want to run, but if you're still bullish on it, you ask, does it make sense to go to more at the money with the 55? Well, sure. If you're comfortable with the expectation, you're comfortable with that, keeping the same expiration, we're going to roll to the 55 to 40. It's a 15-point spread in this case. And what are we going to do to our cost? It's about the same as what we just saw with the 50-35. The 15-point spread almost stays about the same, isn't it? It's 287 value. I got to be honest with you. I don't know. Maybe I'm too conservative, William. This return, this new debit here of a 632 on this 15-point spread is almost equal. The numbers are almost identical to doing the 50-35. The monetary debit, including the gains that we took in from the original position, and the maximum return. Maybe I'm too conservative here. If you saw a true benefit of doing this, I'd say if that's your sentiment, yeah, the 55-40 would be, if you like this 15-point spread, you like that new cost, that would be good. But I don't want to cross that line and give advice, but I would, seeing the same exact numbers, I'd be tempted just to stay at the 50-35 if I was doing that. Yeah, just because the higher probability and the better safety of staying in the money a few strikes below. Both look really good. Of course, then you also have to look at it when you know the stock better than I do. I'd be looking at this in relation to, of course, is there any fear with the open interest or activity on some of these 35s, the 40 or the 45? Probably not. You were able to get the 25-35 earlier, so you should be able to roll to it now as it's going up there. But is there sort of a lag in activity, open interest, or volume? Let's just take a look while we're here. Let's take a look at that whole chain. All right. So I don't have it set here. So let's do that. I'm just going to add and remove columns. I just want the simplest things. I want current option volume and open interest. That's it. I'm not even going to rearrange it. We're just going to put it at the end of our table here. Yeah, see, the 45 is some activity today. So let's go to the correct month, Mike, shall we? There we go. Excellent. Wow. Not too bad at all. Let's go to the large chain there so we can see the 35s too. Yeah, so there's activity. There's plenty of activity. That's for 18 contracts a day on the 35. There are no current activity, but there's a good open interest. That 40 strike, some volume today and good open interest. All 55s, 50, 35 good open interest. The 30 had some good action today as well. It's pretty impressive for something that's that far out in time. Yeah, so that's pretty good. That's not an issue there at all. All right, so that's we're pretty good there. In that case, yeah, I'm leaning towards staying with that one. Now, let's go back one last little exercise here. Let's go back to the main one. That was your original position. When I take these two out, when we just close the position, we talked about liquidating it. We're at a profit of 345. Let's remember that. And shoot. We were looking at now those different values of the 15-point spreads, William, of looking at about a 280, 287 cost basis to $1,200. Let's clear this all out of the board. Are you getting any advantage going further out in time? And we said we like the 50-35. So let's take this into account. Let's sell the 50 for 2023, buy the 35. Debit of 555 to 945. That's pretty good. But let's remember, let's take 340 off of this, 345 off of this. That puts us at 30. It was 30.95, right? Yeah, so 30.50. That's taken into account the profit from your original position. 210 to 12.90. Say you're getting $70 to $80 cheaper in debit by going a further year out, assuming you can get the midpoint. That's a big assumption, getting the midpoint with these far out options for the right price, William, and a profit of $12.90 instead of potentially, was it 1200, 1210, 1212, 1215, something we were looking at on the last one. Did I write it down here? 1212, I think. So you're getting a little lower cost and a little bit bulk up. That's for the 700 days out, which means what? It means it's gonna lag. The reaction time in these options is gonna lag. You're not expecting, you might get half of that return in the next 8 months to 10 months, depending on how far the stock continues to rise, but it's also going to lag and be much slower. You're getting a little bit better price going the extra year out. You're getting a little bit higher profit going extra day out. I'm tempted to stay with the shorter term, to keep focusing on the 2022 rather than looking at the 2023 in this case. I don't know if we need the extra 350 days to make this trade work. Going from 400 days out to the 707. Was it 400? I just see that. 343, I'm sorry. 343 days out instead of going out to 700. I think staying in here would do that. Now, remember what I showed you when we shortened the strike prices, William? We talked about keeping the same expiration for January 2022. We're taking that 345 profit off the table for your initial bull call debit position. Another thing you had asked about is what happens if we move closer in time? Okay. We could roll back to July. Let's cut it in half. Let's just go back to July and use that same strike, 50-40 or 50-35 that we liked. Okay. So let's enter that. We're going to move it closer in time. We're keeping that 15-point spread, and it's a debit of 835. But let's take our profits off the table, put us down to 2230. Yeah, 2230, taking into account the 345. Higher cost, similar return. It's double the exposure. And why? It's likely due that we were seeing larger bid-ask spreads naturally, William, further out in time, and we're basing this off of the midpoint in that case. These probably have a much smaller bid-ask spread. Let's look here. It's about $1.10 to 70 cents versus 220. It's double the time, double the difference, to 230. Yeah, so if you get the midpoints, those are pretty good. I don't know if these are priced well enough here. It's still a good spread, don't get me wrong. It's about $500 for a 15-point spread. You know, it's a pretty good payout as well. Factoring in your gain, though, you might get $1,000 faster because you're going to see more time decay only 150 days out as opposed to 343, William. But it is a higher cost, which is quite interesting in that case. Oh, yeah, and your time value decay will work faster, William. Absolutely. As you move shorter in, those time decays are going to move much faster in your favor to decay as well, rather than sitting on the 2022s, which are going to be much slower in time decay range also. Okay, so it's a valid point, though, because in the next 3 months, if the stock stays above 50, you might be getting closer to the max profit here. You might only be at about half the max profit you're expecting, or $600 with the January. I'm talking about like May, April or May, probably closer to May. If the stock keeps going up, you might be getting closer to the max profit on this July as you move it in, William, as opposed to that profit might just go up another couple $100 or $200 or so, you know, from the 350 it is at now up to 450, maybe 500, but still not at the max profit. We might be at 700, 800 profit on this one as we get closer to expiration. That's exactly right. As the time decay starts to move out of the July series. And as long as the stock stays at 57 in this case, stays at this price range for us as well. All right, so that's some discussion on the Bull Call Debit spreads. There was a customer who had emailed in earlier today. We just covered it. It was a Bull Call Debit spread, but in reverse. It's a Tesla spread. And I'm just going to cover this while we're talking about it. We're going to keep these two in the same one. That's not what I wanted. I'm sorry. Let me go back. In any case, the Tesla spread is well below both strike prices, but he's out to April in this case. Let's go to the profit and loss chart here. There's a spread of a $3,800 cost and 2-to-1 ratio. And with the pullback recently, he's got the 850 and the 950 in this case. And what was interesting about this position, he's saying, should I manage it? Should I roll the short call down in this case to pay for it? And it didn't work out to where the math was going to be a positive return. So some of the things we could consider to do here, of course, is what was interesting is that this position is only at a 13% loss. The max loss is the debit of 3,800. If he liquidates right now, he's only at a loss of 533 or 14% of the total investment. So in this case, with it moving against him well below his short call strike price, that is an option, is to just close and take the smaller loss. Close the position, of course, and as we saw for William, in this case, a defensive maneuver is we're taking the loss of that 530, taking the loss of that 533, or roughly about, in this position. So could I roll down from the 950 and 850 and do a spread maybe that's at 875 and maybe 820, a 50-point spread or something along those lines, that's still going to be the potential profit of 6 or 7 points, where I can counter this with one move and keep maybe the same expiration. That's an opportunity as well. The other opportunity, of course, is to do the pendulum adjustment, which we talk about with the bull put credit spread. And what we could do there is maneuver the short call lower in strike, or we could move the long call to actually create now sort of a bear call credit spread, with the 850 now being still, or the 950, excuse me, being the pivot still, but on a position where if this can still be done at a credit, we've converted a bull to bear with one move, with the market not going in its desired direction. But this is an April series, and Tesla is Tesla. So there's still an opportunity here, even though the stock's way down here. That's where his break even is. It's below both, I'm sorry. He's 850, 950, and the stock's, at 816 now. But Tesla's Tesla, and this is an April spread, so it does have the opportunity to potentially come back into the gain. I'm sorry, what I did here is I was talking about buying to close his short call for a gain, and then perhaps selling an 840 to create that bear call credit spread, leaving his 850 in place. That's what I was doing. I was looking at it backwards for a moment. But that's a possibility that he could do. But the risk now is if it recovers and goes back above 850, now he's at a loss on the bear call credit spread, where he'd be starting to get back into maybe profitability range on the curve red line there, with the time value still remaining on the position. So it's a tough one. There's time left on this one, but the time value will start to decay on the spread that's moving against him, with both below his 850 long and his 950 short. He could take off some of the exposure by rolling down the call. He could convert it to a bearish position if his sentiment has completely changed, or just exit. No one wants to do that, but if you're only taking a $533 loss, 14% of the 3,800 investment, and you don't expect the stock to recover anytime soon, William, just like William said, as we get closer to April, we're going to start losing the time value on these options. They're going to go to zero unless the stock starts moving above some of these strike prices really fast. So that's just the opposite way of looking at an opposite scenario of a bull call debit spread, and some of the things I discussed with the customer today via email as well. Okay, so William, you're welcome. And it says, thanks, very thorough explanation. Thank you, William. That's great.